Yo, what's up YouTube? How you guys doing? Hope you guys are good. Hope you guys are living right. Welcome back to another video. If you're new around here, make sure you hit the subscribe button and turn on that notification bell so you can be alerted every time I drop a new video. In today's video, ladies and gentlemen, I'm back again with another Forex tutorial. Here today talking about the 4 main strategies used by profitable traders. Now, ladies and gentlemen, I need you to understand something before I proceed with this video. On this YouTube channel, there are multiple videos talking about different kinds of strategies. And what you should understand about the financial market or the Forex market or the crypto market or whatever market it is, in general, they're all it's just the financial market. So what you should understand about the financial market is that different traders from different places literally create their own strategy to literally trade what works for them. So with that being said, ladies and gentlemen, it doesn't mean that you need to try out every single strategy. You only need to try out a strategy. If it works for you, ride with that. If it doesn't work for you, do not try the strategy at all. So with that being said, on this YouTube channel, there are so many different kinds of strategies. You guys can literally just scroll down my playlist and look at the different kinds of strategies that I have made on this YouTube channel. So you guys can check out what works for you and what doesn't work for you, what you can stick with and what you can't stick with. So with that being said, in today's video, we're going to first look at the 4 main ways or strategies used by profitable traders on the financial market. Okay, so using some slides, I'm going to explain these strategies and exactly how they work. Okay, ladies and gentlemen, so the first kind of strategy used by most profitable traders is known as the moving average crossover. Now, the moving average crossover, ladies and gentlemen, is basically 2 moving averages that usually cross each other's paths to determine whether the market is going to go in an uptrend or the market is going to go in a bearish trend. Now, with that being said, ladies and gentlemen, I'm going to just show you real quick how it works. First and foremost, let us put the little indicators. Let's put the indicators, main chart, moving average. So preferably you could use a period of 100. One should be a period of 100. Then you say done. And then you add another moving average with a period of let's say 50. You can honestly use any kinds of periods, but preferably use 150 or 200. Preferably you could use that, and it would be more accurate. So put 50, say next, done. With this one, we're going to have to change the color so we can know which one's the 50 and which one is the 100. So we'll put it as green and we say done. Okay, so ladies and gentlemen, as you guys can see, we have the green line, and then we have the red line. Okay, so the red line is basically symbolizing the higher period moving average, and the green line is symbolizing the lower moving average. So how this works, ladies and gentlemen, is that when the lower moving average green crosses over the red moving average, okay, it has to cross over the red moving average. Usually in situations like this, the market is going to be bullish for some time or a few hours. Another thing that you should understand is that you need to trade on the 4-hour time frame. You need to look at it on the 4-hour time frame. That's when you're going to get more accurate results. It's not always accurate, but it's a way that most of the profitable Forex traders use. Of course, they're going to use this strategy and also use a few kinds of analysis, to basically match their predictions so that it can make much more sense. So as you guys can see, in this case, this is a bullish signal. It could be a bullish signal as it crosses the green, crosses the red, and then the bullish begins. The green moving average, which is the lowest moving average, shows you signals of bullish and actually bearish. Of course, you can do it vice versa, but I would rather just use one moving average, which is the 50, to show you what I'm talking about. So in this case, for example, when the green went across the red moving average right here, the market became bullish. When the green crossed downwards under the moving average, the red moving average, downwards the moving average, it started coming downwards. So this usually happens throughout the market. When you see a signal like this and the market is actually in a downtrend, understand that the downtrend will continue coming down. Another position of proof is right here. Now this is something that you need to be careful of, because you can never be too certain. Right here, the green crossed over the red and we had a bullish chart right there. We had a bullish chart, but was not too significant. Of course it wasn't too significant, and that's why sometimes you need to be 100% certain and also use other kinds of analysis to match your prediction. So after that, you can also see what happened in this case right here. The green again touched down and crossed the red moving average coming down, and we had a bearish market. And then after that, we saw the same right here. The green crossed up again, and then we had a bullish market. So as you guys can see, this actually keeps happening throughout the market. This keeps happening throughout the market. As you guys can see, this right here is the most recent, where the green crosses the red coming downwards, and we have a bearish market, as you guys can see. And now currently happening in real time, the green has crossed above the red moving average, and we are expecting an uptrend. So once you see this, always expect to start buying or rather selling. So this is one of the ways they use to predict how the market is flowing. So with that being said, that's the first way, that is known as the moving average crossover. Okay, now let's take a look at the second way that most profitable traders use. The second way is known as the breakout trading. Now most of you traders understand this. Let me just use a slide real quick. This is what is known as the breakout trading. All right, ladies and gentlemen, so now illustrating from this slide, we're going to talk about the second strategy used by most profitable traders. This strategy is known as the breakout strategy or breakout trading. Now, what this simply means, ladies and gentlemen, is that a trader is going to analyze a chart using support and resistance. Okay, if you guys don't understand what support and resistance is, I've done videos about support and resistance. You guys can click in the corner of this video and you can check that out. So with support and resistance, once the support and resistance is placed and then a chart starts to roll, you will find that a trader is going to trade or place a trade in the direction of the breakout. Now the breakout can either break out upwards or downwards. As you guys can see in this case, it has broken out downwards, meaning that immediately it breaks out, the trader is going to start selling. Now this is it's a really good signal it's a really good signal for forex traders when they're using this kind of breakout strategy, because it's very accurate, probably 80 to 100% accurate. So you will find that using this strategy plus other strategies, you can easily predict what the market is actually going to do. So this is what is known as the breakout strategy. If you guys want to know how to use support and resistance, go watch that video. So if you guys want to learn more about support and resistance, you can go watch that video. This right here is another slide illustrating the same thing, support and resistance. So you basically find the highest level of the market on that day and put your resistance, and you find the lowest part of the day and put your support. And then in between, you could literally trade in between. That's known as the resistance and support trading method. And then also when it breaks out, it moves to the breakout trading strategy, and you can also trade while it breaks out. So guys, as you guys can see right now on this chart, it broke out vice versa compared to the other one. This one broke out downwards, then this one broke out upwards. So immediately breaks out, it's a confirmation of entry, saying, oh, okay, now we can start buying, and then you basically buy. So that is how the breakout trading strategy works. Now let's talk about another kind of strategy known as scalping. Now, scalping is probably something you know, something you've heard of, because on this YouTube channel, that's what I usually love to teach. Now, as you guys can see on this slide right here, this is a scalping strategy. We have scalping is basically short term. You scalp the market for profits as you trade. Okay, as you trade, you scalp the market for profits. So as you guys can see, with this indicator that is showing on the chart, this is the same indicator I was showing you guys of the moving average. They're basically using the crossover moving average and using the scalping strategy to milk as much money as you can from the market, because these are all short term. Okay, these are all short term. I know here it might be saying long term, but actually they're all short term. Now, using this strategy, scalping is basically, okay, so ladies and gentlemen, scalping is just basically a strategy used, it's a strategy used for short-term traders to take advantage of the profits that are made from the market. So basically, when you scalp and then you're using technical analysis for your analyzing, it's much easier for you to literally scalp and get many profits out, because what scalpers do is basically they place many trades in order for them to get to take advantage of the market. Immediately they see a short-term line, they place as many trades as they can. So for example, in this case where we're seeing the different crossover patterns being made, a scalper would have entered maybe even 4 or 5 trades, or maybe even more than that. The scalp, get their profits, to come out and do the same again. And just like that, it's also a very good strategy to use as a forex trader. Okay, so last but not the least, I'm going to talk about position trading. Now, position trading, ladies and gentlemen, this is a kind of long-term trading. Okay, position trading is basically a long-term kind of trading strategy, and this is how it works, gentlemen. So position trading basically involves trading, taking a long-term view of the market and holding position for a very long period of time. Now, with the main aim of basically catching the large trends of the market and cashing in on the big profits. Now, how this position trading is basically used and analyzed, of course, you can use some technical analysis, you can use you can basically use the economic calendar, and as well as the candlesticks. The candlesticks play a very, very important role in the long-term position trading strategy. Now, in this case, you basically ride the trends, and as you guys can see from this little slide that I have, position trading uses candlesticks, so you need to also understand the different kinds of candlesticks. There are different kinds of candlesticks, such as the morning star, the bullish candlesticks, the bearish candlesticks, the retracement candlesticks, and so on and so forth. So you need to understand all these different kinds of candlesticks so that you can understand when a big trend is coming, or when a big bearish signal is about to drop. So for example, in this case with the entry point, that was a huge trend that basically kept riding, and during the exit point, the trend started to drop. A very good example of position trading, or where to use this strategy on, is cryptocurrency, Bitcoin to be specific. As you guys can see, Bitcoin is basically used, or rather moved, with supply and demand. So you will find that, for example, now, or rather the time Bitcoin dropped up to around, if I'm not mistaken, $16,000. I think it reached 15. I can't even recall. When it dropped that low, people started buying because they understood that when Bitcoin starts to retrace, or rather to skyrocket again, it's going to be a large trend. So a lot of people place different positions. Maybe the place their buying position on $17,000. Others place their buying position on 16,000, and so on and so forth. And now, as we speak, they're in profit because Bitcoin is at 17,500 and something dollars as of this video. And only God knows where Bitcoin is going, because Bitcoin has hit $65,000 before. So I will not be surprised if it does the same thing this year. So that is a very good example of position trading. Now, with that being said, ladies and gentlemen, thank you so much for watching. Hope you guys found some value in this video. If you did find any value in this video, make sure you subscribe, hit the notification button so you can be alerted every time I drop a video, and share this video to a friend if you found any kind of value. With that being said, you can also join my free Telegram group. The link is in the description. Signals are posted every hour and then. It's a public group. And then I also have my private group where I'm charging $50 to teach what Forex trading is from scratch, and also a few strategies that I'm going to throw into that little course that I'm having. So with that being said, if you're interested in that, that is a private Telegram group. Only join that if you're willing to pay $50. If you're not willing to pay $50, join the free group, join the public group basically. So with that being said, thank you so much for watching. Stay blessed. Peace.